Good afternoon, everybody. Welcome to today's morning coffee with Mike. We are back. We are talking about pullbacks and how to handle them. Last week, the market started to pull back rather hard. Not a crazy hard, but let's take a look at how the market has been pulling back over here. So here is a snapshot of the major indexes. Major indexes started to pull back last week. You could see them right here. Move my face down a little bit. Uh, they started to pull back on the 27th. Started to pull back only down about, let's see, about 2% so far, 2.5% on the S&P. Similar over here on the Nasdaq, about 3.8, and each of the other indexes are looking fairly similar. So the question is, how do you handle pullbacks like these? What should you do? How should you handle them? We'll get into all of it. We'll look at the indexes some more. We'll take a look at some of the stocks that have been getting hit. But before we do all that, what I want you to do is to take some notes. Take some notes, post them to your social platforms, and tag me in those notes. So that way, if you do that, I will repost it to my socials as well. So let's take a look at the indexes once more, and then take a look at some of the stocks that have been getting hit. Right, so we've got these stocks here, and take a look at some of the stocks that broke down. And come over to this here and take a look at some of the stocks that are breaking down. Right, so for example, TMDX, Bilco, Coco fell hard last week, is starting to come back. Monday, Path, just a number of these names have fallen pretty hard. There's Shopify, Fortinet. Fortinet was down. How much was Fortinet down? About 25% from when it pulled back and undercut that purple moving average that I have set there. That's the 21 period exponential moving average. So you see stuff like this happening, and you see it happening in the stocks that you're trading, or maybe some of the stocks that are on your watch list. And you might think, well, what should I do in this scenario when the market's pulling back? There's three main things that you're going to want to do. The first thing that you're going to want to do is stay calm and stick to your plan. Whatever your plan happens to be. We all trade differently, but let's say that your plan was that you are short term, or maybe you're a swing trader. If you were to see any of the pullbacks like what we just saw here, right? And so let's put this back over here for a moment. If you were to see something like this where you're in Fortinet, or let's see, let's go to a different one here. Let's say that you were in Palo Alto, right? This was one that I tried to get into right up here. I had missed this entry down here. I was in several other names that were running hard back then, but this one would set up again, and I attempted to get in right over here. So if you're swing trading, like I am, you might have bought right here and then sold out just a couple of days later. And the reason why is because on a swing trading basis, this is starting to break down below the last couple of days lows over here. It built a short-term level of support, and so you would be out, right? So that's my plan. Somebody that is a little bit longer term might have been holding one like this. Like, let's say you're longer term, you probably wouldn't be buying there. You probably would have bought somewhere down here. In which case, Maybe you held through this. Maybe you held through this. Maybe you're holding and hoping that, oh, well, the 50-day moving average hasn't been violated yet. And you're seeing that red line. That's the 50-day moving average. Maybe you're waiting for that to be tested. Well, then you're out on that one. And so you would be following whatever your plan is. I'm not saying that that's the best plan. I'm not saying that's the optimal plan. I'm not even suggesting that that's a good plan. But whatever your plan happens to be, that's the plan that you should be following. The time to grade your plan, the time to make tweaks to your plan, that comes later on. That comes after the trade is done. That comes when you've laid out your time for post analysis. So hopefully, you have a mechanism where you are taking notes on your trades. You're writing down not just where you entered and where you exited the trade and the dates and all that kind of stuff, but you're writing down all your reasons why you entered, all your reasons why you're exiting at a certain point or why you're planning to exit at a certain point, any thoughts or emotions that you might be feeling, journaling those kind of things. Maybe you're also journaling about general market conditions, taking as much notes as you can throughout the life of the trade. And then later on, when the trade is closed, then you could go back and see how well you followed your plan and if your plan was effective or not. Then you could start to come up with different tweaks to how you might want to manage things in the future. That's when you do that, not in the middle of the trade. During the trade, for better or worse, follow the plan. Step number two of what to do during pullbacks. You want to have a screening process and watch list. We've spoken about this a few times here, but it's worth mentioning again. So, screening, your watch lists are going to be some of the best tools that you have if you're doing it routinely and you're managing your lists well. Here's why. If you're screening for if you're running the same screens every single week, you're going to be capturing certain types of market data. For me, I want to focus on growth stocks. So I'm screening for terrific earnings and sales, high ROE, high growth rates. I'm screening for relative strength. I want stocks that are going to be leading the market higher. I'm screening for all these things. And so when I screen for those things, one, it's filtering out much of the noise. I have a watch list of about 300 stocks. My universe list is about 300 stocks. The full market has about 10,000 stocks. So I'm narrowing the whole thing down to 300. Great. And then each week I'm seeing, well, these are the types of stocks that are coming onto the list. These are the types of stocks that are falling off the list. And then I'll be able to go through that list and make a sub list. The sub list is all the stocks from within that universe that are setting up in the type of patterns that I'm interested in. That in itself is going to tell me if it's a good time to go to the market and do some buying or if I should be sitting on my hands and waiting. I'm going to see how many stocks are setting up. I'm going to see the quality of those stocks setting up. And if the quality isn't there, then I don't want to buy. It would be like if you went to the supermarket and you go to the supermarket and all the vegetables are moldy and wilted and look disgusting. Would you buy that stuff because it just happens to be on sale? No, you would walk right out of the store. Same thing with the market, and that's what your watch lists are going to help you do. You're going to look for your setups. You're going to see how many setups do you see, and then you're going to assess, well, are these quality setups? Yes or no. And if they're not quality, then don't take them. Keep the money in your pocket. The other thing that setups are going to do for you and your watch list and screening is going to do for you, it's going to help you be objective, right? You don't need to listen to the talking heads on the news, on social media, anywhere else. You're going to allow the market to do the speaking to you, and all you have to do is listen and assess what's there. It's a far more objective way to look at the market, trade, and uh, really reduce the emotional part of it. Uh, so much of emotions comes from listening to talking heads, you thinking one thing, somebody else is saying something else, and then there's a lot of confusion. Screw all that. Use your watch lists, let the market do the talking, And that's really the only thing that you need to be listening to. Number three of what to do during pullbacks is to learn and master multi-time frame analysis. Multi-time frame analysis is the thing that will help you get into trades early. It will help you hold on to and ride winners, and it will also help you exit trades before they sour. Here's a few more examples. And so let's bring the charts back up. Let's take a look at Dash, right? So we just went through Palo Alto. I told you that this was one that I attempted to enter here. And actually, multi-time frame analysis is what helped me exit just, let's see, how much. So if I'm entering here and I'm exiting here, I'm exiting with about a 2% loss. Part of what helped me do that, right? Because how would I know that entering there and then the pullback is happening that wouldn't be so great? Part of what showed me that was multi-time frame analysis. So I'm looking at this trade here and just put my annotations back on. I saw it tightening up. I saw it starting to break out. And then when this fell and it fell below a level of support that was created right there, that told me, okay, this trade is souring. It's not what I thought. Time to exit. Great. Here is another trade because let's take a look at a winner. So here's a winning trade. DoorDash. This was a trade, and I'll take my annotations off because I draw all over my charts. It helps me, but it probably doesn't help you at this point right now. If you were to go through some of our other content or to join our elite program, then a lot of this stuff would start to make sense to you. But as far as this chart goes, I saw it tightening up progressively here, here, here. And so that's what made me want to enter at this level. And it wasn't just looking at this daily chart. It was taking a look at how are things on the weekly time frame, right? So you could see that same tightening over here on the weekly chart. And you could also see very similarly on the 30-minute time frame. Right? So let's get down to the 30-minute, reset this, and come over here, right? So this is tightening up here, here, and then over here. And I entered right on this, right? So very tight. That last little tightening right there is where I got in, and I got in with only 4.5% risk. So what I was able to do with this was to ride this up all the way and then exit the last bit of it right around here. And that was telling me that the trade was beginning to sour. And the reason why it's beginning to sour is what? Maybe you could see it uh, already. Part of what was helping you know that the trade is souring is that you see this green line. That's the 10-day exponential moving average. It was getting support around it for the entire move. And then here's a violation. It comes down to that purple line. That's the 21-day exponential moving average. It pops back up. Then it violates it again, and it's making a series of lower lows now. I could come over here and look at the daily time frame, and I could see it starting to undercut a few of those levels. I could see it doing similar on the weekly now. It had all these up weeks on the weekly time frame, and then last week it put in what's called a negative outside reversal week, where price pushed higher, pushed lower, and then closed at its lows. That is a big danger signal. So seeing those things happening across time frames is part of what helped me to not just ride DoorDash for the bulk of those gains, uh, ending with about a 20% move overall. But part of what it allowed me to do was to exit before the trade started to sour even more and pull back. Perhaps it sets up again. We don't know. No, nobody can really forecast the future, but we can continue to observe the name, because it passed all of our screens before. We were in this, we made a bunch of money on it, and then we could see what new setups develop in this thing to see if it gives another chance. Just because a stock starts to deteriorate, it doesn't mean that we need to hold on to it. We can lock in gains, we could lock in partial gains, we could lock in all of our gains. There's many different tactics and strategies for how to finesse trade management. Talk about them in the book. I talk about them on these streams. I talk about them inside our different programs and courses. Um, right now, if we come back over to the chart, it seems like it might be getting some support around that red line. That's the 10-week line. If we jump out here, take a look at this. It's a little bit clearer that it's not quite at the support level yet. It looked like it might be based on the 10-week line, but if I'm looking at this, that makes it a bit noisy. If I'm looking at this, it looks like it needs more time to get to the 50-day moving average and perhaps come over here and test another level that could be interpreted as prior resistance turning into support. We'd have to see. But it's looking at the price action, not just on one time frame, it's taking a look at the price action across time frames. I just put out a mini course on this very topic. I'll link to it on the platforms that you're watching, so that way you could go check that out. It's already getting some great reviews. And that's it. Let's take some questions. What questions you guys have? Start from the top and scroll down. Some people joining from other parts of the world. Good evening. Evening time over in India. Evening time in a couple of people from Dubai. Welcome, welcome. Question from Thanos129 over here on Instagram. What are the moving averages that you're using? So on these charts, and I'll switch this over again. Excuse me. The moving averages that I have set up are the 5 EMA, that's that thin gray one, then the 10 EMA, 21 EMA, 50 SMA, 100 EMA, and 200 SMA. Those are the moving averages that I have set up here. Now, a question from Thanos. What is my quality setup? Great question. I will show you. Excuse me one moment. Let's bring up my playbook here. So I had this spreadsheet. I call it my playbook. There's a lot of different tabs on this thing. And one of them down here is my setups. So each one of these is my setup. And what makes a quality setup is having it be well defined and that it works. So how can you define your setups? You want to define your setups based on a few different things: the time frames that you're taking it on, how long the pattern should be, both overall as well as near the pivot point. The pivot point is where you're looking to enter this thing. Then the amount of bars around the pivot itself, the depth of the pattern and the depth near the pivot, how it should look overall, then the placement within the trend. Is the trend moving sideways? Is the trend moving? Is it within a broader uptrend? Is it in a bear market? When are you taking this thing? All that stuff is there. And then the boosters for the pattern. What takes it from good to great? And then, of course, you want to have a few different models of the setup. So that way, whenever you are looking at a fresh setup, you have something to compare it to. So, for example, if I'm looking for a pullback, I would compare it to this trade here in Zscaler. Zscaler, nice pullback, pulled back to the 50-day moving average. Notice how it found support right at the moving average right there as it was consolidating and it was tightening up right around that level. Something else that I noticed was the relative strength line outperforming the price action. Uh, Up here, the stochastics turned positive before price broke out. So, and also I noticed the volume declining on down days versus the up days. So all those things were things that I liked for pullbacks. So when I go and look for other trades that are similar, I want them to have those qualities, and that's part of the litmus test that I would want them to be able to pass. Let's see, what other questions do you have? Here's a question from YouTube. When you got a losing streak, what is your lowest position size and will you buy pullback in the bear market? Sure, I'll buy pullbacks when they appear. I will buy quality setups when they appear. Sometimes a quality setup will show in a bear market, sometimes it'll show up in a bull market, sometimes it'll be a sideways choppy market. When quality setups appear, it could be a sign that that is one of the stocks that could be a leader. And it's important to have clear definitions of what a quality setup is and have all the different definitions there. So that way, you know for sure if you're dealing with something that's quality or if it's something that is, just kind of so so. Have checklists for these things. Build checklists. The checklist that I use is on my website. You could use it for free. It's called the Trade Gauntlet. The website is called marawealth.com. I'll pull that on the screen for you guys. So this is it right here. Marawealth.com. You just come over to here, go to links, and use Trade Gauntlet Calculator, and this pulls up my full checklist that is very detailed, has weights assigned to each one of these criteria, and you can feel free to use this tool or make a version of it for yourself. So that way, you have a foundation to check the quality of your trades, and that tool has been an absolute game changer for me. Now, to answer the other part of the question uh, about position size, when I am struggling, I will continuously cut down my size. The reason why is because uh, the market trends both to the upside and to the downside. The systems that we have will not work 100% of the time. They will work when the market is trending, and it's a good time for our system. So, because the market trends and you'll start to get bulks of winners all at the same time, you want to be pressing the gas when you're getting a lot of winners, right? That's where a notion called progressive exposure starts to come in. Progressive exposure also works on the downside. So let's say that you're on a winning streak and then all of a sudden the market starts to turn and then you start to struggle, then that's a time to start to cut back and then cut back more and cut back more. So that way you are trading your best when you're trading your biggest when you're trading your best, and you're trading your smallest when you're trading your worst. So let's say that you just had a couple of losers. You would cut the position size. I would cut my position size all the way down to 6.5% of capital to be allocated to that position at most. I would be risking 0.5% of capital at most. Sometimes I'll risk even less. Sometimes I'll only risk a tenth of a percent of capital. How do I risk so little? Because I like to enter when volatility contracts on the trades. So when I find patterns like the one that I showed you in ZS Scaler, you notice that it was contracting and I got in super duper tight. Same thing with DoorDash. Same thing with Palo Alto. And I also know when to exit these things so that way, if they do sour, I'm out in a hurry. Palo Alto, I'll show you that chart again. Right. So here is that's DoorDash. Let's bring in Palo Alto. Right? So I'm attempting to trade this. It starts to sour. I'm out on this day right here. I'm not even waiting until the close. I'm getting out early. I'm out with only about a 2% loss on that move. And in the subsequent days, it's down how much? Right? So I'm out with a 2% loss. If I waited until the end of the day, I'd be out with a 6.5% loss. And if I'm still holding it, then I would be down 15%. That's why it's so important to cut losses while they're small and to have a great way to do it. Multi-time frame analysis can help you. And again, I just put out a new course on multi-time frame analysis. I made it super affordable. It's only $7. You don't have $7. What are you doing trading? But it's available for you guys right now. And check it out. Next question. Do you look for confluence while taking a trade? Absolutely. I want to see multiple levels of confluence around my entry points, multiple levels of confluence around where I'm placing my stop. Confluence is like, uh, think of it a lot like the floor, right? Like, so if you're looking at where you're going to place your stop, would you want your floor to be made out of concrete or would you want your floor to be made out of wet tissue paper, right? Like you want it to be made out of the solid concrete because if price falls and you have all this confluence around there and it breaks through the concrete, you know that something's wrong and that you should be getting out of this thing. If you don't have confluence around where your stop is, then maybe it violates it and comes right back, and then you're thinking, oh well, but coming up with all different kinds of excuses, right? A common excuse is that oh the market makers shook me out and took my money. Hey, 9 times out of 10 from where I see people placing the stops, it's because the stops are in an inappropriate place. See what other questions you guys have. We're already at the half-hour mark, so take a quick question if there's any more in here. I want to see you guys posting the notes that you wrote up from this stream. Uh, Tell me the different your different takeaways. Post them on social. Tag me. If you tag me, then I'll reshare it to my main stream so that way everybody can see what you guys are getting out of this. Any setup for an ultra short-term trade? Well, you could find the same setups, the same structure. Like, let's say that you were looking at what I wrote in the book or what I was sharing before. It, I'm swing trading, but you could say find the same structural patterns down on a 30-minute chart, down on a 15-minute chart, down on a 1-minute chart. I'm sure you could find volatility contracting, and that's basically what you want. You want to see volatility contracting over time and getting narrower and narrower and narrower because what that's going to create, it does a couple of things for you. The first thing that it's doing is that it's creating a very tight reward to risk area. So it, if price breaks out and goes, then you're only able to get out with a small amount of risk. If price falls, you're able to define your risk very clearly. That's what you want to have in any kind of trade that you're going to take. If I'm taking an ultra short short-term play, then I would also want to be trading in the same direction as the higher time frame. So, and I'm not just talking about the 30-minute or the hourly. I'm talking about the daily, the weekly, the monthly. I want to be trading alongside that trend because that's where all the waves are moving. I was out on the boat yesterday, and there were different sized boats in the marina and different sized boats as we were going out to this beach in Long Island. It's called Toe Bay, Town of Oyster Bay, Toe Bay Beach. Great spot for those of you that know. There's different sized boats in the marina, and you see people leaving their slips, and they're going. You see the ripples in the water. All the boats are making their own ripples in the water, but the bigger boats are going to have bigger ripples than the smaller boats, than the jet skis. And so, as we're going in our boat, it's about 36 feet long. It's making its waves. Behind us are people on jet skis, and they're going and they're using the waves from our boat to jump and launch themselves into the air. It's a lot of fun. But the same thing happens in the market too. And if you are trading against a time frame, a higher time frame, and you hit one of the waves from the daily, and you're trading the 30-minute or the 1 minute, let's say, it's going to knock you off your ski and you're going to go flying, right? That's why you want to be trading or at least be aware of what the higher time frames are doing, so that way you know where the waves are, you know where they're coming, and you could take advantage of them better. Multi-time frame analysis is a very important thing. So go grab that new multi-time frame analysis course. All right, that's it. If you guys need any other help, you know where to find me. Just send me a DM, an email, send up a smoke signal, get a hold of me, and make sure that you are posting and sharing your notes on social media. And again, if you do that and you tag me, then I will repost it on my feed. That's it for today. I'll see you again tomorrow. Take care. Much love. Peace out, everybody.